Inflation is typically characterized as a widespread rise in prices and a decline in the buying power of money. For example, if a six-pack of beers costs $8 last year, but $16 this year, then the yearly inflation rate was 100%. This is because the price of the same quality and amount of beer doubled. To put this in context, the most well-known hyperinflations happened in Zimbabwe and Germany. Zimbabwe's monthly inflation rate reached 7.96 times 1,010% in 2003, while the German government's hyperinflation drove the exchange rate to soar to 4.2 trillion German marks to $1 in 1923. Welcome to Crypto Inquiry, where we are dedicated to providing you, the investor, and the crypto curious with factual information and topics. Our goal is to keep you informed to make educated and timely decisions and remove the fog of hidden information. Nothing is meant as financial advice, and always do your own research before investing. Here we are building a community to help each other stay informed and make the most of our financial gains. Does crypto protect against inflation? According to the conventional definition, Bitcoin is deflationary since its purchasing power grows over time. According to the British Currency School, the conventional definition of inflation was an increase in the quantity of money that was not backed by gold. Governments have been inflating money for the past 800 years, according to Reinhardt and Rogoffs. This time is different. Originally, governments would debase gold coins to increase the currency. Government inflation technology expanded to printing presses over the 20th century, and governments may now inflate the monetary base by digitally producing money by updating internal databases that monitor fiat money, which is mostly digital. According to the standard definition, Bitcoin is inflationary since its supply grows over time. Because of one special characteristic, scarcity, gold is regarded as the ultimate repository of value. No one or no organization can make gold appear. Nature rather controls the supply. Gold supply has had a consistent inflation rate. Bitcoin's creators aimed for a constant inflation rate similar to that of gold. As the inflation rate falls, the price of each Bitcoin should rise, all else being equal. Bitcoin's inflation rate is hard-coded into the Bitcoin software, akin to Milton Friedman's K% rule, which advocated for an algorithmic and controlled inflation rate to minimize human error and the temptation to manipulate the monetary base for political reasons. The Bitcoin inflation algorithm, on the other hand, was meant to make Bitcoin even scarcer than gold. There is a set quantity of 21 million Bitcoin that can be created, which implies that once this amount is achieved, no coins can be manufactured. Around 80% of the entire quantity of Bitcoin has already been created. Satoshi Nakamoto's original white paper explains Bitcoin's algorithmic inflation rate since 2010. To compensate for increasing hardware speed and varying interest in running nodes over time, the proof of work difficulty is determined by a moving average targeting an average number of blocks per hour, Nakamoto explained. If they are generated too fast, the difficulty increases. Bitcoin's inflation rate was 4.25% in July. Because of the difficulty of readjustment, it is no longer feasible to simply mine additional Bitcoin by dedicating more computer resources to the network. As more individuals attempt to mine Bitcoin, the software raises the complexity of successfully mining a Bitcoin and vice versa. Miners will no longer be able to make money by minting freshly minted Bitcoins if the inflation rate approaches zero. Instead, transaction costs or the number of transactions will have to rise. The most recent edition of the Crypto Research Report includes an in-depth description of how network transactions are validated and how miners make money by verifying transactions and minting new currencies. Although Bitcoin and gold are now inflationary money, their inflation rates are predictable and steadily decreasing. According to the classic definition of inflation, Bitcoin's yearly inflation rate, like gold's, will finally hit 0%. Bitcoin is deflationary, according to the usual economic concept of inflation, because its buying power increases over time. Bitcoin's purchasing power is now very volatile, but this is likely to normalize in the long term. Because Bitcoin's total quantity is fixed, its purchasing power will gradually increase over time if demand remains high. Can cryptocurrency inflation happen? Experts disagree on the tolerance of cryptocurrencies to inflation. According to several crypto specialists, governments cannot affect crypto blockchains. As a result, they can't distribute too much cryptocurrency and devalue it. If a country experiences inflation, crypto assets will be unaffected. Because cryptocurrency is a new concept, there isn't much data to show that Bitcoin inflation may occur. According to some analysts, inflation is helpful to the digital asset industry. Because fiat currency is losing value, many individuals are investing in cryptocurrency to store value. Increased demand and investment in a coin raises its value. However, there are dangers to using cryptocurrency for value storage. According to economists, inflation will continue high in the coming years. Bitcoin and other cryptocurrencies lost up to 2/3 of their original worth as inflation increased. This demonstrates that inflation has an impact on the Bitcoin market. Historically, Bitcoin has seen significant volatility. Cryptocurrency is classified by investors as either a commodity to trade, like gold, or a security to invest in, like stocks. Both of these variables are susceptible to inflationary pressures. It's critical to remember that not all cryptocurrencies are created equal. Some crypto blockchains work differently than others. Cryptocurrencies can be the following 3 traits. 1. Deflationary. These cryptocurrencies' supply will dwindle over time. The value of the cryptocurrency should climb as the supply decreases or remain stable. This mechanism is used by Bitcoin. The blockchain divides the quantity of new Bitcoin in half every 4 years, an occurrence known as the halving. Bitcoin's block reward likewise declines with time. As the value of Bitcoin has climbed over time, this strategy has proven to be effective. Number 2, dynamic. In this situation, the blockchain eliminates old cryptocurrency and creates new coins or tokens based on particular parameters. Stable coins, which are tethered to the value of a fiat currency, are susceptible to this. Terra USD is a stablecoin on the Terra network that is tied to the US dollar. If the value of the USD fell, so would the value of Terra USD. Number 3, infinite. When a cryptocurrency has no supply limit, it is endless. Ethereum is a well-known example. Ethereum's blockchain is used by developers to construct new projects, such as NFTs, which keep it in high demand. There is no need to place a supply restriction on it because it fulfills so many functions. Inflation-proof versus hedge against inflation. Cryptocurrency has not yet proven to be a successful inflation hedge. It is still a comparatively new investment type, but it is one worth considering for inclusion in your portfolio. However, nothing in investing is certain. Purchasing cryptocurrency does not provide you with an inflation hedge. In addition to fraud and severe hazards, there are also false narratives out there. As a result, while purchasing or storing cryptocurrency, you must select a high-quality, recognized service provider. Because of its limited quantity of the 21 million and speculative character, cryptocurrency experts and investors have always promoted Bitcoin, the original crypto, as an inflation hedge. Bitcoin's value is, in principle, uncorrelated to the stock market, classifying it as an alt or alternative investment alongside fine art, wine, and precious metals. However, the crypto market has been closely tracking the stock market in recent months, indicating that it isn't as impenetrable as early adopters claim. Terra, or UST, an algorithmic stablecoin, fell in May, wiping approximately $400 billion in crypto market value in a few days. It's been a perfect storm, and cryptocurrency investors are left wondering how long-term inflation will affect their holdings. To discover, we questioned 2 financial experts about the relationship between long-term inflation and cryptocurrency, as well as what investors should do to manage the uncertainties. According to Brandon Neal, the chief operating officer at the DeFi lending protocol Euler and former trader at the Federal Reserve Bank of New York, cryptocurrency is still too immature to predict how inflation would influence it. It might not have necessarily been true that crypto was a good inflation hedge. It may have just been coincidental, and that up until now, crypto merely looked like it was a good inflation hedge, Neal told Next Advisor. Look at gold, for instance. If you decided to cherry-pick points in time, certain data points throughout its history, sometimes you could look at gold and say it is an excellent inflation hedge. But you'd have to ignore all the times it simply wasn't. More likely, Neal contends, Bitcoin has created the perception of a hedge since its inception in 2009. However, with only 13 years of data at a period of historically low interest rates, it's hard to predict whether this will continue in the future, especially considering how markets and global circumstances have evolved. Because Bitcoin is decentralized and not tied to any central bank, it could become a good hedge against inflation over time, according to Chris Brendler, managing director and senior research analyst at D.A. Davidson. But the current volatility and speculation in the crypto market are overpowering Bitcoin's underlying value because it is still a new asset class. The crypto market has recently been mimicking the stock market because trading sentiment is taking over near-term fluctuations, and so much of it is tied to speculation, according to Brendler. If there's a lot of money printing going on, Bitcoin should hold its value over time, he says. What we don't know is how much of it is speculation, and we're continuing to see that come out. I think it will be proven over time to be an inflation hedge, but not this time. That's a wrap for this video. Let us know in the comments below if you think crypto is a good hedge against inflation. If you enjoyed this video, give this a big thumbs up, and do not forget to subscribe to our channel if you want to see more videos like these. See you next time.